I've had so many people in business or running their companies who ask me what tax applies to me, should I register for all of them, and what's the difference? Under VAT, there's something else that is called VAT special table. So being compliant based on the tax that you're registered for is very important for your business because you will not incur penalties and interest from KRA. Hello and welcome again to another episode of the Prosperity Thrive Drive. In our tax series, we are going to look at VAT versus turnover tax versus corporate tax. My name is Charity Mwangi, your host and a financial consultant. I've had so many people in business or running their companies who ask me what tax applies to me, should I register for all of them, and what's the difference? So today in this episode, we'll get that clarity, and by the end of it, if you're running a business or having a company, you'll know the right tax that applies to your business or your company. So we'll look at what each tax means, who it applies to, the rate of tax, the registration threshold, the filing requirements, and the advantages and the disadvantages of each. So let's first have an overview and define each of them. Turnover tax is a simplified tax for small businesses based on their gross sales. VAT or value-added tax is a consumption tax on goods and services. Corporate income tax is tax on registered company on their profits, meaning the sales less expenses. So let's now look at each tax, and we'll start with turnover tax. So turnover tax is designed for micro and small businesses with gross sales between 1 million and 25 million per year. For SMEs that have a gross turnover of less than 1 million and do not qualify for turnover tax, they are also required to file and declare their corporate tax returns. The rate of turnover tax is 3% on gross sales. The other thing you need to know is that there are no deductions allowed. So you apply the tax on the total sales. You don't deduct any expenses. Also to note that with turnover tax, you have to file every month by the 20th. So the tax for the previous month, you're supposed to file and make the payment by the 20th of the following month. Turnover tax does not apply to rental income or professional fees or any income that is subjected to withholding tax. And also turnover tax does not apply to non-resident taxpayers. So if a business has made 200,000 in sales, for example, in January, they'll calculate 3% of that, which will come to 6,000, and they're supposed to file and remit the 6,000 by the 20th of the following month, which now will be February. So who should register for turnover tax? Small businesses with gross sales of 1 million to 25 million per year, non-VAT registered businesses that are earning over 1 million annually, and sole proprietors and startups can consider turnover tax. The good thing with turnover tax, it's easy to calculate. It's a lower rate because it's at 3% on gross sales. You don't need a complicated bookkeeping system for you to calculate turnover tax. It reduces your record-keeping expenses. It has a simplified filing and payment process. And then also turnover tax is final tax. However, there are disadvantages of turnover tax. Number one, if you make a loss, you'll still pay turnover tax because turnover tax is based on your sales. Also, if your income exceeds 25 million, you're required to register for VAT and corporate tax. Anyone registered for turnover tax should be very careful because you're supposed to file and pay on a monthly basis, and late filing and payment will attract penalties and interest. Next, let's look at VAT, or what is called as value-added tax. So VAT is charged on the value added at each stage of production and sale of goods and services. We have standard at 16%, We also have goods that are charged 8%, but we also have others that are zero rated. For you to register for VAT, your sales should exceed 5 million Kenyan shillings per annum. You're also required to file and pay the VAT by the 20th of every month. So the tax for January, for example, you're supposed to pay by the 20th of February. So what are the advantages of VAT? Number one, you're able to recover VAT paid on business inputs. With this, I mean, you are able to deduct the tax that you are charged when you're purchasing the goods. However, for VAT, it requires very accurate records because the invoices that you enter into the system must match what the buyer has entered versus what the seller has entered. If you're registered for VAT, you must ensure that you keep very accurate records. Also ensure that you don't miss the monthly filing and the payments, because if you do, you'll attract penalties and interest. So how do you go about deregistering for VAT? If your turnover has gone below 5 million, you're allowed to deregister for VAT. Let's also look at withholding VAT. So withheld VAT is remitted by appointed withholding VAT agents to the commissioner on the 20th day of the month following the deduction. So if the VAT has been withheld in January, it should be paid by the 20th of February. Withholding VAT is charged at the rate of 2% of the value of the taxable supplies. Under VAT, there's something else that is called VAT special table. So this is a mechanism that has been implemented in iTax to enhance VAT compliance, where certain categories of VAT registered taxpayers are restricted from performing certain processes. These are the categories: those people that file nil returns and those people who do not file at all. The other one is missing traders, and this refers to taxpayers who are filing and paying VAT, but on investigation they are found to be involved in VAT fraud relating to missing trader schemes. So what are the benefits of the VAT special table? Number one, they're able to identify erroneously added VAT obligations or VAT obligations that are no longer required. Number two, it reduces the cases of abuse of traders' PIN by fraudulent persons. Number three, it assists traders to conduct business with compliant suppliers. So what happens if you as a taxpayer is onboarded to the VAT special table? So you will be restricted from filing VAT returns, and upon attempting to file the return, the system will display the message of this PIN is currently under review for VAT compliance irregularities. Please also note that penalties will not be charged for non-filing of VAT returns as a result of onboarding of a taxpayer on the VAT special table. The other thing is that the traders or the taxpayer cannot claim input tax from taxpayers onboarded on the special table. So you're supposed to contact your KRA office so that you can be removed from the VAT special table, because if you're onboarded on the VAT special table, you will not be able to trade, and that results to a loss of income. Let's talk about VAT on imported goods. VAT on imported services is also referred to as reverse VAT. So who should pay for VAT on imported services? Any importer of an imported service, irrespective of his VAT registration status, is liable to pay VAT on the imported service, which is called reverse VAT. Let's now talk about the corporate income tax. Corporate income tax is charged on the net profit made by registered companies. The rate is 30% of the net profit for resident companies and 37.5% of the net profit for the non-resident companies. The filing should be done annually by June of the following year, but also for corporate tax, the companies are expected to be paying installment tax, which is paid in 4 installments during the year, The first one by the 30th of April, then 30th of June, then 30th of September, and 31st of December. And any balance of tax, you're required to pay it by the 30th of April of the following year. So the advantages of the corporate income tax is that it's based on the profit. So if you make a loss, you do not have any tax to pay. However, it requires accurate bookkeeping and also audited accounts. Also, the penalties for non-compliance, for late filing and late payment are very severe for corporate income tax. So let's have a recap of the turnover tax, VAT, and corporate income tax. Number one, the turnover tax is based on the gross turnover. The VAT is based on consumption, or the difference between the input VAT and the output VAT. For corporate income tax, the tax is based on the net profit. The rates, we have the turnover tax at 3%, VAT at 16%, and the corporate income tax, it's at 30%. The threshold for turnover tax is between 1 million to 25 million annual turnover. For VAT is from 5 million and above annual turnover. And for corporate income tax, it's for all registered companies. The frequency for filing, for turnover tax, you're supposed to file on a monthly basis. For VAT as well, you're supposed to file on a monthly basis. And for corporate income tax, you're supposed to file annually and have the quarterly estimates. Deductions allowed for turnover tax, there are no deductions allowed, that is expenses. For VAT, the input VAT is allowed, and for corporate income tax, you can deduct your expenses. So turnover tax is suitable for small businesses, VAT is suitable for formal traders, and corporate tax is of course for registered companies. So being compliant based on the tax that you're registered for is very important for your business because you will not incur penalties and interest from KRA. If you're a business owner and you'd like assistance with your tax management, feel free to contact me. My email is on the description box. So that's it for today on this tax series as we discuss the turnover tax, VAT, and corporate income tax and their differences. See you in our next episode, and please subscribe if you haven't done so. Like and share and comment and tell us what else you want us to discuss in this channel. Please share this channel with your friends, with your family, with your circles, and let them also participate and get to hear what we are discussing. Let's meet on the next episode of the Prosperity Drive. Until next time, God bless you.